Thank you for joining us for the Restructuring Lawyers to Tax as set forth in the slides. This is the second episode in a three-part series. Today's episode will focus on corporate taxation. There is a prior session available on demand that discusses through pass-through entities and individuals, and there's an upcoming session on November 19th that'll focus on cross-border and multi-jurisdictional tax issues, and the treatment is somewhat different on some of these issues depending on what kind of taxpayer you have. My name is Bob Richards, and I head the Global Restructuring Group here at the Denton's Law Firm, and I'm your moderator for today. Speaking of the slides, we will not be reading the slides or going through the PowerPoint in order. You do not have to read the slides during the presentation. They're really intended more as a takeaway afterwards to provide you some more detail on some of the topics. This is really intended to be a conversation and something that you can take notes on. We have an excellent panel for you today. We have David Agler from Agler Law and Crow Hervoth. We have Stephanie Drew from Rubin Braun, and then we have John Harrington, who heads the U.S. tax group here at Denton's U.S. We appreciate that you're not spending your time to hear about us. More details and bios are available on slides 43 to 47 of the slides. This webinar is a production of Financial Poise. They do have a very helpful weekly newsletter that I subscribe to and that you can subscribe to as well. That's at financialpoise.com / subscribe. If you're attending the live premiere today, you can ask questions through the web portal. If you're listening to this on demand, you can just email any of us at our bios on the slide or send an email to info@financialpoise.com with your question and your information, and we will get back to you on your question. We would also like to thank our co-producer today, the National Law Review. With that, why don't we get the discussion going? So this is mainly tax driven, and we have three tax experts on the call. I'm primarily a bankruptcy lawyer and an insolvency lawyer. I will lead off by describing the different kinds of insolvency in the U.S., and then we'll turn it over to the panel. Sometimes bankruptcy occurs in a federal bankruptcy court, and that's what most people think of, but it can occur in other ways. Sometimes there's an insolvency outside of a formal process, and that's common for real estate. It was common in the dot-com era. There can be a receivership, which can be in state or federal district court, where a receiver is appointed either to run the whole business or certain aspects of the business. For instance, a mortgage holder takes hold of a property that is pledged to it under the mortgage. There is also, in some states, a state law assignment for the benefit of creditors, where the assignee kind of acts as a trustee for trying to administer the assets put into the trust. And then there can be debt workouts or exchange offers where the debt is either extended or part of it's converted to equity or its terms are modified. And we'll be discussing the significance of some of those aspects as we go along in the presentation. With that, when we talk about taxes, there are all sorts of different kinds of taxes, and insolvency has an impact on some of them and not as much on others. But Stephanie, can you kind of walk through the kinds of taxes that the audience should be thinking about?
Yep. So I think that the biggest piece to remember is taxes don't just go away because an entity is insolvent. And we want to really think about taxes sort of in a couple of buckets. We want to think about those taxes that are really the obligation of the corporation or the entity and the taxes that are trust taxes that somebody else has paid and given to the corporation that need to be forwarded. So when we think about taxes of a corporation, we all think about income tax at a federal level, maybe at a state level. But the other thing to remember is that it's just not income tax that you have issues here with. You have, especially at the state level, you have you may have a state that has franchise tax. You may have a state that taxes on property taxes. And you need to make sure that you're paying attention not only to that federal component, but also to all the different state issues, as well as municipalities, because you may be in a city and county and they have their own set of taxes that they would like to collect. The other piece that's really, really important that you think about, especially when you have an entity that is insolvent, are those trust taxes, because sometimes we have a tendency, insolvent companies could maybe use those trust taxes for other things because they're short on cash, but it's not really their money. So think about the state sales tax. The customer pays those taxes to the corporation or the entity, but it's not the entity's money. Those dollars need to be given to the state or the taxing authority. The other piece that's really important to think about and make sure is being paid as entities become insolvent and you're working with them are the employee portion of the payroll taxes, anything that's being withheld. That may be their actual withholding taxes, their portion of Social Security and Medicare, if you've got dollars that you're taking from them to pay their medical premiums, or even garnishments. Those are not dollars of the enterprise, they're not dollars of the entity, and they need to be forwarded onto the appropriate taxing authority.
And in my experience, the taxing authorities are quite diligent about following up on that. They really do take it very seriously in terms of wanting to get their money. And there can be liability not only for the corporation, but also in some states for officers and directors. So, it is something to pay attention to. Um, let's talk a little bit, Stephanie, about some of the impacts of bankruptcy, what it changes, what it may not change.
I think that one of the misnomers that even I still get questions on sometimes is that bankruptcy doesn't really change the tax reporting at the entity level. The elections that corporations and entities make prior to filing for bankruptcy, those still all exist. They don't just go away because you filed bankruptcy. When we think about partnerships, single member LLCs, corporation, they all end up on that same tax path. And I think that one of the things with all of those entities, you want to make sure that if you are making elections that involve tax right before the tax filing, or I'm sorry, right before bankruptcy or any sort of other legal legal filings, you want to make sure that you're paying attention to what changes you're trying to make. So if you are a pass-through entity and you try to make a change to have it, to get rid of your LLC election, and instead of being taxed as a partnership, you want to be taxed as a corporation, or if you have an S corporation and you do something to make that S election defective, those are things that you really want to be paying attention to, because in a lot of cases, they can come back and sort of bite you. In some instances, if you're in bankruptcy and you have a trustee, you have made an election so that that tax obligation shifts from an individual to the corporation or to the entity. That may be a fraudulent transfer. And so you want to really make sure that you're paying attention to what you're doing both before any sort of formal bankruptcy proceeding takes place. The one sort of exception to that has to do with individuals. Individuals who are in either Chapter 11 or 7, they do have a new entity gets created, and a estate gets created specifically for them. And if it's a married couple, you have 2 entities that get created. And you still want to make sure that you are paying attention to the tax implications related to those filings, especially as it relates to cutoff periods. There may be a reason that you want to, Chapter 7 or 11 individuals may decide to do some sort of a cutoff period for a short tax year, in order to keep certain tax attributes either at the individual letter or at the estate level.
Thanks. And then once you file, typically, I as bankruptcy counsel would send out a notice to all the taxing authorities that we filed so that they know that there is a filing. David, can you kind of walk us through when a taxing authority gets a notice, kind of the things it needs to think about in terms of the treatment of tax claims in the bankruptcy case?
Yes, the bankruptcy code provides a comprehensive procedure for resolving tax and non-tax claims. It provides for a procedure for filing claims. So either the debtor could file a claim for a particular creditor or the creditor will file the claim. In the case of tax claims, the general rule is that the government has 180 days to file a tax claim, but the court can provide an extension for that. And if there's a failure to file a claim by tax authorities, in Chapter 7 cases, there's a mechanism for them to get paid on a subordinated basis. The bankruptcy code provides, first of all, it defers to the Internal Revenue Code and generally state and local laws for determining tax liability, filing tax returns, as Stephanie mentioned. It also provides a procedure for priority of claims and a procedure for the bankruptcy court to determine certain tax liabilities during the bankruptcy and even in some cases pre-bankruptcy, although pre-bankruptcy is discretionary. And it also provides a procedure for prompt determination of taxes, which is very important so that a plan can be adopted in the bankruptcy. In the case of priority, secured claims have priority, cost of bankruptcy administration, priority, then comes employee claims, then you have certain tax claims and unsecured claims, and then equity claims. But the thing to keep in mind is in the case of secured claims, the bankruptcy code allows for a bifurcation of a secured claim up to the value of the security, and then the remainder of the claim can be treated as an unsecured claim. In the case of receiverships, just so you know, the same procedures don't apply. There are different rules that apply regarding priority, determination of taxes. There is no special rule for determination of taxes to close a receivership case, although there is a bill in Congress that was recently enacted that would change those rules. But given the fact that Congress is closed, the government is closed, it's unclear when, if ever, those bills will be taken up.
Thanks. And one thing I would note is sometimes tax claims can be both tax claims and secured claims. So real estate taxes are a common example of that. Sometimes if the taxing authority has already filed a tax lien before the bankruptcy occurs, at least the portion that's subject to the tax lien could be a secured claim as well. Uh, John, can you talk a little bit about what entities are treated as a corporation for income tax purposes?
Sure, Bob. An entity is treated as a corporation for federal income tax purposes. If so, then it's generally subject to corporate income tax on its income. Now, we're really talking about potentially two levels of tax. There's the income imposed at the entity level at the 21% federal corporate tax rate plus the applicable state tax rate. And there's also the taxation that the shareholders will incur on the dividends that are distributed up to them. two things to sort of keep in mind about that. One is that second level of taxation is deferred until there is a dividend. So there's two levels, but there can be deferral between the first and the second level of taxation. And the second is that the taxation of the dividends is, subject to whatever the particular rules and attributes of the shareholder. So it's pretty predictable what's going to be the treatment for the corporation itself, but what the impact on its shareholders can vary on a shareholder by shareholder basis. So, well, what's a corporation for federal income tax purposes? It's pretty easy if the entity is formed under a state incorporation statute. The answer there is generally yes. If it's got Inc. or Corp in its name, then it's generally a corporation for U.S. federal income tax purposes. If it's a so-called regular corporation, then it's subject to that 21% federal corporate tax rate that I mentioned and the applicable state tax rate. Now, there are some entities that are corporations for U.S. tax purposes. They're subject to special taxation rules. One, the S corporations, which are small business corporations. We discussed those a little bit in the prior the prior episode. Those are effectively like they're effectively pass-through entities, but they're technically corporations and subject to certain rules. There's also corporations that have special rules like real estate investment trust or regulated investment companies where they're subject to effectively one level of tax as long as they distribute their earnings. But these are situations where there's elections been made, like Stephanie mentioned some of the elections that an entity might make, before getting into starting proceedings or getting into financial trouble, and how those are relevant. So those are things to keep in mind. Even though something's a corporation, you can still be subject to special corporate rules. Now, if you're an entity that's formed under U.S. law, other than a state incorporation statute, then the entity's corporate or non-corporate status depends on the elections that it intentionally or unintentionally makes. We have entity classification rules. We call them often the check the box rules that so if an entity is formed as a partnership or LLC, it can elect to be a corporation or pass-through entity for federal income tax purposes. If a partnership or LLC files a Form 8832 electing to be a corporation, then it's a corporation for federal income tax purposes. If it doesn't file such an election, then it's a pass-through entity. Partnership has got multiple entities. Disregarded entity has only got a single owner. So that means when you encounter an LLC or partnership, in this environment, you need to know whether you're dealing with a corporation or a flow-through entity. And so you've got to ask about entity classification elections that the entity may have made. Now, because an eligible entity can change its entity classification, and like an S corporation or a REIT or RIC can lose eligibility or change its election with respect to that status. You have to ask not just about what elections an entity's made, but what elections has it revoked, or just because you've seen one election, you got to find out whether there were subsequent elections that would have changed it. So that is something where there's a certain amount of due diligence. You need to ask about them, but you need to make sure that you've seen all of the elections to feel comfortable in that regard.
Thanks. And in my cases, a lot of times the businesses that file have lost significant money, usually for multiple years. Why generally that's a bad thing. It also can result in what's called an NOL carry forward, where the losses can be used against future taxes, assuming the business can be turned around and can use the NOL to help shield itself from future taxation. John, can you expand a little bit on what an NOL is and what some of the key rules are, and also what a tax attribute is?
Sure. Yeah. I mean, you raise a good point that often tax people are telling, we're telling companies things that are normally bad are actually good, like losses. But the tax attributes, like you were referring to, Bob, such as net operating losses, they can be one of a debtor corporation's most valuable assets. And so therefore, you have to be careful of transactions that could cause those attributes to be lost or diminished. That could be because the transaction, triggers a disallowance or results in a limitation, or it could be because you do a transaction that just generates, unexpectedly generates a lot of income and therefore burns through net operating losses or other attributes. Now I'm going to go back to the point I was making before about the two-tier aspect of of corporations. The prior episode we focused on pass-through entities, and so we focus on the attributes that are at the owner level because the income's flowing up, and similarly with any sort of new attributes. Now, with a corporation, the attributes are at the entity level. You still care about distribution coming up to the shareholders, but in some ways it's simpler because there is a single entity that's got the attributes, and so it makes it easier, I think, in that case to see and value those particular attributes. Now, when it comes to potential negative impacts on attributes, there are a lot of traps for the unwary. For example, Section 267 of the Internal Revenue Code denies a loss on the sale of property from one related party to another. So you can have an intercompany transfer of property with if that property's got built-in loss, then you can wind up losing that loss if you make an intercompany because of the intercompany transfer. And sort of example about where you can kind of, this can run afoul of this rule, perhaps inadvertently, is like, suppose you've got a company, it's in financial trouble, it wants to sell some assets, it's found a buyer. The assets are located in different subsidiaries. And so the buyer says, instead of wanting to deal with a sales agreement where I'm buying from all these different companies, just put them all into one vehicle, and I'll either buy the vehicle or buy just deal with that one, with that one entity. I mean, you're doing this for the convenience of the buyer or maybe for packaging or marketing purposes. But in the situation like that, if it's a transfer from one regarded entity to another, from one corporation to another, then you have an intercompany transfer before you have that sale to the third party. You can wind up, triggering that loss disallowance, even though it's all with the intent to go out to a third party. You're not planning on trying to generate a false loss, a fake loss or anything like that. But if you do something like that, that may make business sense, can wind up causing you to lose a loss. You have to be careful about, doing an intercompany transfer that caused you to lose a built-in loss in that situation. Now there also, because we're talking about corporations, there are certain limitations on the use of attributes, they can often differ from those that apply to individuals or pass-through entities. Speaking of net operating losses, one of the most significant is, and we'll talk about this later on in more detail, but there is a provision in Section 382 of the Internal Revenue Code that significantly limits, the ability to use losses following a change in ownership. Corporations also have, just like individuals do, have limitations on the use of capital losses. Those rules for corporations are different. So you have to be mindful of if you have one doing something cause you to lose a capital loss carry forward because you burn it up because of a transaction, or you wind up doing something that generates significant capital losses that you can't use. So you can have an attribute that's not really available, that's not valuable in terms of using. Another area that you need to be careful about when it comes to attributes is in the context of consolidated groups. If you have a group of corporations, parent company that owns more than 80% of several subsidiaries, if that group has elected to be treated as a consolidated group for tax purposes, then it's subject to special rules. It's generally treated as one taxpayer for U.S. tax purposes. But that also means that when you have transfers outside of that group, you can wind up triggering gain or loss or resulting in using up attributes of other entities of the group, because in the context of a consolidated group, certain intra-group transfers, like a sale from one consolidated group member to another, doesn't trigger gain. It's just deferred until later on. You have a transfer that's outside that group, you wind up triggering gain, not just from the selling corporation, but from a previous transaction. So again, those are things where you may not necessarily appreciate in terms of 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 something like that being triggering the uh a gain, and also the impact on attributes of the group. We'll also talk about tax-free reorganizations later, but but here it's worth emphasizing that when we talk about the importance of preserving attributes, you still have to be able to use the attributes. And so one thing to be careful about is if you do a transfer of, say, assets to another entity, could even be a related entity, and those are income producing assets, then you can wind up separating the favorable attributes from the income. So you've got the income producing assets now in an entity that's can no longer offset them with these net operating losses or other losses that are still up in the selling entity or transferring entity. And then meanwhile, the transferors got these net operating losses, other attributes, but no income to offset it. So preserving attributes is important, but you also got to make sure that you can use those attributes. And sometimes that transfer can wind up resulting in you preserve them, but you can't, you're paying more tax because that income is no longer covered.
And
When,
we've
go ahead.
talked about transfers and reorganizations, but as I understand it, actions by others can sometimes affect your tax status too. Like if your lender forecloses on you, that may have a taxable impact as well, even though you didn't do anything, your lender took the assets away from you forcibly.
Yes, yeah, no, that's a very good point. And it also just, that's probably worth one sort of final note about how these rules can interact with each other. And so a transaction that's it may be intentional because you think you're going to drive a benefit. It could be an action that a third party takes, just like you mentioned, Bob. That can have an interaction with with other provisions, and so and you can wind up having an unexpected detriment. So, for example, if a party claims a worthless stock deduction, you've invested in an entity, they think it's no longer worth anything, so they want to that shareholder wants to drive the tax benefit itself by taking worthless stock deduction. That results in a change that can result in a change in ownership. That is a potential shifting in the ownership, and so you can wind up triggering limitations or NOLs or built-in losses or these separate return limitation year limitations in consolidated group areas. So again, it's just like you point out, it's not just what you do, but it's what other people can do that can have an impact on you.
Thanks. Just as we talked about tax losses as being an asset and actually could be a positive thing, I often see in my bankruptcy cases a plan where, you're paying the creditor, the unsecured creditors 10 cents on the dollar, and you're like, great, I'm saving 90 cents on the dollar. But David, can you talk to us a little bit about cancellation of indebtedness income and why saving that money with the creditors may not be as great from a tax perspective?
Yes, for those of you who have practiced in the area of bankruptcy, insolvency, or workouts, you've heard the dreaded term cancellation of indebtedness income. And so for those of you who are not tax lawyers or tax professionals, I think you need to put on your 3D glasses here, because when we talk about cancellation of debt income, and the general rule is that anytime you have a cancellation of debt, and there's certain exception in the case of sales of assets that we'll talk about where you have non-recourse debt, where that debt can be treated as purchase price and not be treated as cancellation of debt income, but can be treated as capital gain or ordinary gain, depending upon the asset. But the general rule is that cancellation of debt results in ordinary income to the debtor. In a couple of minutes, we'll talk about exclusions that make cancellation of debt income in certain circumstances more favorable than having the capital gain that we just spoke about. But for purposes of tax, we're talking about not necessarily a legal discharge or legal extinguishment of the debt. We're talking about when, in substance, the debt is not going to be paid, or it's unlikely it's going to be paid. That's where you would have cancellation of debt. It can happen under the bankruptcy code. It can happen where there's a negotiation by the parties to reduce debt. It can also happen where debt is acquired at a discount by a quote related party. That's a tax term where there's an exchange of the debt for new debt, or there's a debt modification that can result in cancellation of debt income. It can occur where there's a capital contribution of the debt or contribution of the debt to the debtor in exchange for equity. So in those circumstances, you can have cancellation of debt income, which would be ordinary. The important thing to remember is that there are numerous exceptions to cancellation of debt income. And if these exceptions apply, then generally the quid pro quo is that the debtor doesn't pick up the income, but is required to reduce tax attributes such as net operating losses, tax credits, basis of assets, and some other attributes. So that's the quid pro quo. So what are these exceptions? Well, there's an exception in bankruptcy that if the cancellation of debt event occurs under a plan or it's granted by the bankruptcy court, then there's an exclusion for that amount of CODI, what's referred to as CODI, cancellation debt income. And there's this reduction in tax attributes. If you have a company that's either in bankruptcy and fails to get the bankruptcy exception or is insolvent, there's an insolvency exception where the exception applies to exclude income up to the amount that the cancellation results in insolvency of the debtor. Again, you have a situation where you can reduce tax attributes. And in some cases, as John mentioned, those attributes may not be usable or may be subject to the limitation, the 80% rule, where you can only use it up to 80% of income. Or if you're in California, California right now has a moratorium on use of NOLs for companies, and I'm saying this generally, with income of $1 million or more. So those losses, in that case, reducing those losses, could be beneficial as opposed to having to pay tax on those. Other exceptions, if the debt that's being canceled for tax purposes, if it were paid and it would result in a deduction, then it's also excluded. If the reduction occurs as pursuant to a purchase of an asset, it may qualify for a purchase price exception where you just don't pick up the income, but you get to reduce basis of the assets. There's an exception for qualified real property indebtedness, farm indebtedness. There's also one for contested debt where the extinguishment may not result in cancellation of debt income at all, so you don't even have to worry about reducing tax attributes.
And let's talk a little bit more about debt modification. People especially in out-of-court workouts, get extensions, maybe change cash pay interest to PIK interest, reduced interest rates. David, can you talk a little bit more about how much modification may result in a taxable event and, when you're modifying debt terms like that?
Yeah, so material modification of the debt for tax purposes is treated as an exchange of the existing debt for a new debt. And that has tax implications for both the debtor and potentially for the creditor. Just mention that for the debtor, You can have cancellation of debt income if the issue price, again, this is a defined tax, tax term. If the issue price of the new debt is less than the old debt, you can have cancellation of debt income to the debtor, and for the creditors potentially treated as selling its debt for a new debt. And unless there is a tax-free reorganization, we'll talk about that, a recap, then you can have gain or loss to the creditor. So if the creditor wrote down the debt or the creditor purchased the debt at a discount, now you may have an immediate recognition of phantom income, due to the debt modification. So what is a debt modification? Okay, debt modification for tax purposes, term modification is determined as an alteration of a legal right or obligation of the issuer or of the holder. And the regulations focus on 5 areas where they define what the debt modification, whether or not it's significant. And those are a change in interest rates or yield term, change in timing or amount of payments, including a change in the maturity date of a debt obligation, change in an obligor or security, change in the nature of the debt from recourse to non-recourse, or maybe a change in accounting or financial covenants. And just to give you an idea, so in the case of a change in interest rate or yield being significant or substantial, okay, a change in yield is substantial if it varies from the annual yield by the greater of 25 basis points or 5% of annual yield of the unmodified debt instrument. So doesn't really take a whole lot in terms of modification of yield to create a substantial modification and a taxable exchange. In the case of timing or changing in timing of payments, a substantial modification occurs if the modification or the change in timing is a lesser of 5 years or 50% of the original term of the obligation. In the case of change of obligors and change of collateral and nature of recourse, non-recourse, there's a focus on whether or not the change is going to result in a change in payment expectations under the debt. But all of those issues should be looked at, especially if you have modifications before and whether or not, they count for purposes of a substantial modification.
Thanks. And Halloween's coming up. You mentioned phantom income. Can you describe for the audience what phantom income is?
Yes, phantom income is income without cash. So for example, if you have cancellation of debt income where the payments are going to the creditor, there's no cash available. If you are in a pass-through tax entity and the income flows through to the partner or tax partner, or S Corp shareholder, if the income flows through, the cash stays at the entity level and is going to pay creditors. So there's income, without cash. One other thing to just make clear, if you are in an S Corp and you're a shareholder of the S Corp, the exclusions that I mentioned to you are tested at the S Corp level, not at the shareholder level. If you're in a C Corp, John mentioned, it's at the C Corp level. If it's in a partnership or tax partnership like an LLC or single member LLC, which is disregarded, then the event of bankruptcy or insolvency is at the owner level, not at the entity level. So if you have an LLC or a partnership in bankruptcy, they don't qualify for the bankruptcy exception. The bankruptcy exception applies at the owner level.
And one other topic I wanted to cover, David, was change of ownerships. I often see situations where, for instance, the bondholders are really the fulcrum security, and there's no way to repay the bonds in full. So instead, as part of a a bankruptcy or otherwise, they agree to convert some or all of their bond debt into ownership of a new co. Can you talk a little bit about the change of ownership rules and how that may have a tax impact?
The Internal Revenue Code provides for, or it tries to provide for, the non-selling of NOLs, okay? And they do that, they did that by adopting several provisions of the Internal Revenue Code, IRC Section 269 and IRC Section 382. And the only reason I'm mentioning 382 is because there are two important exceptions in bankruptcy or certain receivership cases or workout cases where the 382 rules are changed. But what these rules say is that if you have a change of ownership, then the NOLs are going to be subject to an annual limitation based on the month that you have this change of ownership. The IRS publishes these rates, might be 3-4%. They're not significant rates, times the value of the company at the time, and that's the annual limitation on losses. And states may have different rules on that, but the idea being that they don't want to be able to sell an entity that then the buyer can use the NOLs, okay? Okay, so what is a change of ownership? Change of ownership is basically where you have a change where there's a 50% or more change in the ownership of the company. And again, there are exceptions that we'll talk about. And that can happen a variety of ways: a sale, it can happen from a redemption, it can happen from new capital coming in, and issuance of stock. And so, or it can happen in a reorganization that we're going to talk about, where there's a transfer of assets to a new company, a tax-free reorganization for stock. So if there's a sale of assets, NOLs generally don't go with the company, with the buyer, but in a tax-free reorganization that can carry over to the buyer. And so what, again, 382 does, and it's buttressed by 269, which is a tax avoidance rule, is basically they're trying to prevent or limit the use of NOLs and tax attributes in the case of this change of ownership event. There are two exceptions that apply in bankruptcy, can apply in certain receivership cases, and to other types of workouts. But essentially what 382L5 does is it can treat the creditors, in Bob's example, okay, it treats the creditors as if they're stockholders, okay, because really the equity is potentially in all of the debt. And what happens is, if in a bankruptcy, okay, reorganization, the new creditors and even the old stockholders, if the new creditors in exchange for their debt, okay, when I say new creditors, let me use the word qualified creditors, because qualified creditor is a creditor that is not new in that sense. What it is creditor that's held debt for 18 months or more, or acquired debt in the ordinary course of the business of the debtor. And if under the plan, the creditors, the qualified creditors receive 50% or more of the stock in exchange for their debt, exchange for the old debt, then the change of ownership rules don't apply. However, there are potential cancellation of income issues that I had mentioned before, and also a potential reduction in certain NOLs that might occur as a result of this. But that is one of the key exceptions that's used in bankruptcy, where the creditors come in and become shareholders of the company for their old and cold debt. and there's no change of ownership, but again, potential reduction in, tax attributes because of, cancellation of debt.
Thanks. There's been a couple references already to tax-free reorganization. John, can you start off and kind of describe what a tax-free reorganization is, and then I'll lay it out to the whole panel.
Sure. Usually a tax-free organization is a good thing because it means you're able to move assets or shares, without triggering additional tax. We'll talk about, this is one of the few areas where sometimes you do want to trigger tax. So, you could have kind of an issue that might, that you might not want a tax-free reorganization, but generally there are rules. The rules we're focused on, the ones apply just to corporations. So you need to have just corporations involved in these. If you got a corporation and a partnership or an entity that's, it's not true as a corporation, then these rules don't fit together neatly. But just as a general matter, we do have rules in the Internal Revenue Code that allow a corporation to transfer assets or shares to another corporation or to that corporation shareholders without triggering tax, and that results in no gain or loss. Preservation of attributes. You can have these attributes moved subject to these kind of limitations, for example, that David mentioned. One thing that I just wanted to flag on these, and we can talk this more generally, is that like I said, these apply really just from a corporate standpoint. So it has to be just corporations, but also you can have a situation too where you may, if a corporation has, say, assets that it wants to dispose of, but it's also got significant net operating losses, that there's going to be limitations or an inability to use it. This is an instance where sometimes you don't want to do a tax-free reorganization. It's better off selling the assets, triggering the gain, which is not going to pay tax, so it's got net operating losses, and the buyer gets to step up in basis. So depending on the circumstances, sometimes you have to go whether avoiding the tax, the cost of avoiding the tax versus the potential acquiring the assets, with and is that step up worth more than the attributes? But David and Stephanie?
No, I agree with you. And when you talk about bankruptcy reorganizations, that's one of the issues that sometimes you get into. It also allows the creditors who are getting the assets, if they're creditors that are part of the deal, to basically recognize a loss, ordinary or capital, as opposed to a reorganization where that might not happen and they have to defer.
Yeah, the other thing that I would say just about tax reorganizations is that, they're very complex. And at least in my experience, if you have very large companies, there's usually a lot of tax planning around the tax reorganization and the tax issues. And the smaller companies get those kind of tax planning is secondary or maybe tertiary or doesn't exist at all. And sometimes those are the areas where you could have some real benefit, but nobody really thinks about it because it's just not top of mind.
Yeah. Just one thing I might jump in there, because I think that's a good point, because also, even irrespective of the sophistication of the entity involved, some of these reorganizations are easier to qualify than others. There's things like a B reorganization where it's stock for stock. It has to be purely stock for stock. You can, for good or for bad, you can very easily violate that. Others are much more forgiving, like the A reorganizations were sort of the statutory merger. I mean, so it's even within those levels, some of these are some of these you got to be up for a challenge to to try to meet them. So
And one of our slides talks about e-reorganizations. Can someone kind of discuss what an e-reorganization is?
You want to take that, John?
sure, I'm happy to. The e-reorganization is really a recapitalization, and you're going to run into this in terms of if there is some kind of shifting of ownership. Just like Bob, both you and David were talking about, but this is there's you know, it gives an example about sort of reshuffling the capital structure, but just, you know, this is something you need to be mindful of if there is some kind of exchange of securities. There's no kind of change in ownership, you know, without really no change in sort of ownership of the relevant securities, then you can do this without triggering gain. This is, at least to me, tends to be more of an issue for the holders of the securities rather than the entity itself. Some of these tax organizations, it could affect the entity itself. It can trigger gain, but at least for me, these are one of the easier ones to meet in that situation.
Thanks. We focused a lot on the debtor and the corporate entity, but there are other people that have tax consequences. Stephanie, can you talk a little bit about kind of the issues for lenders or issue for trade suppliers who aren't getting repaid in full in a bankruptcy case or in an insolvency?
Sure. I think that the issue really becomes what um what kind of entity it is, what their business is. So if you are an entity that your business is you're in a company that loans money, you're going to have much different issues as opposed to somebody that you've just extended credit and you are providing really goods or services. And those are two very different ways that those get handled. Making sure that to the extent that if you are I guess I'm not, I think that just like significant modifications happen when we were talking about earlier with the debtor, you have those same opposite issues when you have it for the creditor, and making sure that both sides are taking care of those tax issues.
Thanks. And we've talked also a lot about federal bankruptcy, but you see, especially for real estate these days, a lot of receivership. I'll throw it open to everyone on the panel. What are particular concerns that uh, receivers should have in these kinds of situations? Maybe Stephanie, you can lead us off, and then David, and then John.
Yeah, I think that, for receivers, one of the things that I think we see sometimes in receiverships is that, especially if it's a state receivership, a lot of receivership orders will say that they do not have an obligation to deal with the tax issues. But I think that receivers need to be really cautious about that and need to be paying attention to whether or not they really do have. I personally think they do have an obligation to deal with those tax issues, especially at the federal level. I think that's a really big issue that receivers run into. I think that the other piece with state receivers is that, the IRS's stance is that if the receiver has control over the entity and the substantial control over the assets, they are obligated to file those tax returns as well. I think that from a corporate perspective, control matters. And we didn't really touch on this, but especially in those entities where you have consolidation, you may have an entity that only a subsidiary, one of the children, are in the bankruptcy or in receivership, and some of those tax attributes, even though they're only reported at the parent level, are some of those assets really assets of the subsidiary as opposed to the parent, and kind of those fights around tax attributes. I think that happens both in the bankruptcy as well as receivership type cases.
Thanks. And David, I know you've been involved in several receiverships as well. What kind of issues would you highlight for receivers in terms of these kind of situations?
I think the first issue I'd be concerned about, and Stephanie mentioned some of the problems you have in these receiverships, is the rule is that if receiver has substantially all of the assets or has control over the assets, or some other fiduciary for that matter, could be a liquidating trustee. But if you're in that position you have a potential for, first of all, you're required to file tax returns and pay tax. And the failure to do so could result in personal liability to the receiver. There's a federal priority statute on if a receiver pays unsecured lower priority claims as opposed to higher priority federal tax claims, or any federal claim for that matter, then there's potential personal liability. There are also fiduciary duties, and the failure, I think Stephanie talked about responsible person taxes and things like that. The failure to withhold, the failure to pay those taxes in a timely manner can result in personal liability. I alluded earlier to some of the benefits that the bankruptcy code provides, where they have a procedure to have prompt determination of taxes. That also insulates the bankruptcy trustee from potential personal liability, because under the bankruptcy code, there's a waiver of sovereign immunity for the IRS. That doesn't happen in either a federal or in a state receivership case. As I mentioned, there's legislation that might change that, but for now, that's not the case. And that presents a real problem for receivers because they're required to pay taxes on pre-receivership period as well as receivership period admin expenses. And if there's failure to file tax returns, that could end up resulting in some potential personal liability issues. And it can also hold up the administration of the case.
Thanks. We're getting towards the end of our hour. John, any other observations for trustees or receivers or fiduciaries in terms of, in your experience, things that people need to focus on?
I thought Dave and Stephanie did a good job of describing the issues here. I would just kind of amplify one aspect of it, and that's that that because the receiver is in both a fiduciary situation, and also it has these whether it's implicit or explicit filing responsibilities, the importance of having clarity from a tax standpoint, how the parties are expecting things to be treated. That ideally, certainly before anything needs to be filed, but also ideally for the receiver takes any kind of responsibilities. That is important. You don't want to get caught kind of where you're in the middle of things where you got one group's thinking something needs to be reported another way, and you're having trouble not getting information because they disagree with what you're trying to do. But having that, it's important in terms of being able to exercise those fiduciary duties and the following things, just to have clarity, and just so you're not getting in the middle of fights about how things are supposed to be treated for tax purposes.
And I would follow up on that by saying that should be in the appointment order, which should be very broad as to what your authority would be, as opposed to what Stephanie mentioned, sometimes trying to get around by having a state court or a federal court ruling, which as to failure to file returns are not required, it's probably not enforceable because courts don't have that authority. Under the Anti-Injunction Act and other federal law, they do not have the authority to interfere with the collection determination of tax liability.
Well, I want to thank the panel for an excellent discussion. As I mentioned at the offset, we do have a third episode that focuses on cross-border and multi-jurisdictional insolvencies. So I would encourage you to join us for that session next month. And with that, we're going to conclude this webinar. Financial Poise has a number of excellent insolvency related programs on demand. So I would encourage you to check those out and to listen to those. And again, thanks to the panel, and hopefully see you next month for the cross-border taxation discussion. Thanks, everyone.
Thank
Bye.
you.